Senior Director and Deputy Chief Rating Officer Manish Gupta to understand what's really driving earnings growth for them, the major macro challenges also, and what could drive India Inc. Let's listen into an excerpt of this exclusive conversation.
Just to set the context of our study, if you look at the last few years, the resilience of India Inc. has been built through a very volatile operating environment marked by frequent disruptions. Some of these events impacted demand across sectors such as COVID and US tariffs, while others caused volatility in input costs and supply chain disruptions like a Russia-Ukraine war and the very recent West Asia conflict as well. And to top, if you look at it, closer proximity of these disruptive events have left India Inc. with shorter recovery cycles as well. So when we analyzed 3,200 odd corporates belonging to around 22 sectors, which constitute almost entire India Inc., we found that 65% of the sectors were impacted by at least one event or the other. Of the six were also impacted by more than one event. The sectors like auto, oil and gas, packaging, chemicals, gems and jewelry, and auto components as well. And one sector was impacted by more than three events as well. So, but what's intriguing is that in this period of disruptions, companies have not only sustained revenue growth and profitability, but also strengthened their balance sheets. One of the key reasons we see is a strong domestic volume growth, which stood steady at around 10% CAGR. This is something to do with our strong domestic consumption, which continues to remain healthy. We also grew well in terms of exports as well, in terms of export diversification. I think some of the corporates and some sectors did pretty well. Sectors like shrimp, etc. When faced with difficulties, they actually look forward to expand to other geographies as well. And some of these issues also led to more cost-efficient initiatives as well, something like green power. A few years back, green power used to be only 5% of the power costs, but now it is 15% is what we see. And similarly, services also saw a lot of cost optimization. So we saw pretty good, healthy, resilient growth and profitability coming from India Inc. During this period of uncertainty.
Okay, so that's as far as the last few years are concerned. But as I mentioned, the most important question is the kind of trajectory we'll see going forward. Mr. Gupta, if you have done some back of the envelope working in terms of the kind of growth that you're expecting for India Inc. going forward.
Yeah, so I think we definitely see a double-digit growth going forward as well. If you look at from a volume perspective, I think the volume growth has been quite steady. And the realization improvements have also been there. So while on one hand, the input costs have gone up, but the companies have been able to pass on the input cost hikes through the realization improvement as well. So we definitely see a double-digit volume growth coming in here on.
Okay, so double-digit volume growth from here on over the next few years. But Mr. Gupta, which sectors are likely to aid this growth and lead this growth, and which will be on the other side of the spectrum?
Yeah, so I think sectors like, if you look at the commodity sectors to begin with, commodity sectors like metals, etc., these sectors are showing good volume growth as we see. Consumption-linked sectors like FMCG, consumer durables, these sectors are also heading toward a very good season of growth. As you know, most of the growth or volume sales happen in the festive season, which we are heading into. So that I think is again likely to show a pretty decent growth. But if you look at it based on our report, where we are also talking about the resilience that the corporates have built in. So a very interesting thing that we notice is that on one hand, there is a decline in leverage levels for the corporates. So that I think is providing some of these companies a pretty good, strong base to go forward. So that I think is certainly helping. In addition, companies have raised a lot of equity in the last few years, so which again is providing a lot of cushion and buffers to the balance sheet. So this is actually preparing the corporates towards any further disruptions can happen going forward as well. So I think growth is good, as well as the corporates are pretty well positioned to take care of any other global uncertainties that can come across and hit the growth numbers as
Okay,
well.
so India Inc. is well positioned at this point in time, and commodity led metals consumption will be some sectors that will drive growth going forward. But Mr. Gupta, another factor that has played out over the last few years has been deleveraging, and most companies have worked on strengthening their balance sheet position. Now that the balance sheet position has been strengthened, what kind of opportunities do you see could come up in terms of capital expenditure, and what could the trajectory of deleveraging look like going forward?
So yes, you're right. I think median net debt to EBITDA for Crisil rated corporates is estimated at around 1.3 times in fiscal 26. And when we compare it to fiscal 17, it was somewhere close to 2.4 times. And on top, an interesting thing that we notice is that while equity raises went fourfolds in last 5 years, we also saw that good amount of equity raise has also gone towards debt repayment. So when I say good amount, I mean to say somewhere close to 30% has gone towards debt servicing, which used to be around 10% in the previous 5 years. So essentially, Indian corporates have actually favored to improve the balance sheet strength more than anything else. And with that, we also saw that the funds that are being raised are being used less towards capex. So that's also has come down, and no wonder the capex intensity has also fallen from a zero point 0.6 levels to a zero point 0.5. But this. So what we have seen so far is that the animal spirits around the capex has not come about so much. So, but if I were to put it in another way, we can say that given multiple episodes of disruptions over the last 5-6 years, companies have become very selective in organic expansion as they navigate uncertain demand environment. We are also seeing a more disciplined approach to capital allocation rather than a reduced appetite for growth. So we are seeing good amount of growth coming in sectors like metals, cement, etc. But if you were to ask me, can it be higher? Can it be more? Definitely, it can be more. So companies are still incurring capex well within their balance sheets only, and the real animal spirits or a broad-based capex is yet to be seen.
Okay, so capex intensity definitely has fallen over the last few years, but India Inc. is incurring capital expenditure within its balance sheet position. That's the word coming in. But let's also talk about M&A, because that has also picked up pace over the last few years. And I was just going through your report. You've said that pharma, tech, consumer goods, and media, these are the four sectors which have seen highest transactions and deals over the last few years. But going forward, do you expect these sectors to report higher M&A going forward, or is the trend expected to change and perhaps some other sectors could report more deals in their sectors?
No, sure. So as part of the study, I studied around 600 odd deals which are valued more than 500 crores across 20 sectors. Of course, this excluded the financial sector, infrastructure, and inbound M&As. And our analysis indicates that Indian corporates are increasingly using M&As to accelerate growth. Essentially, they are also looking to expand market access and acquire capabilities that would take years to build organically. In fact, annual deal volumes, as we saw, have more than doubled since fiscal 2017. So we also noticed that more than 50% of M&As were targeted towards consolidation and market expansion, while 18% were towards capability building. So while remaining were towards vertical integration, stake increases, and unrelated expansion. But when we look at it from a sectoral lens, we see that the momentum is definitely broad-based when it comes to M&As, but it is also shaped by sector priorities. For instance, sectors like pharma and health, enterprise technologies, AI, and consumer businesses, they are seeing acquisitions to essentially bridge technology, talent, and IP-related gaps. On the other hand, sectors such as cement and metals, they are going in for acquisitions, for consolidation, and are able to compress build time from 4 to 6 years to around 1 to 3 years using the M&A route. So we definitely see continued M&As on this side, particularly on the capability building. As you're aware, sectors like IT, pharma, etc., they are also undergoing some kind of a sectoral restructuring as well. So that I think is something which gonna fuel the M&As going forward as well.
That was an excerpt of an exclusive conversation we had with the management of Crisil Ratings, who highlighted a double-digit volume growth going forward, with commodities and consumption sectors likely to drive growth. But on